Good to see everybody. Welcome, welcome. Welcome to Heartland Challenge 2023. We are thrilled you are here. My name is Matt Waller, and I am Dean of the Sam Walton College of Business at the University of Arkansas. And we are so excited to invite and to host the 12 graduate student finalist teams here. If you're a graduate student on a graduate student team, will you raise your hand? Let's give them a round of applause. I hope you all are having a great time here, and we're really thrilled to have you. You know, these student teams they're building relationships, they're trying to build their business, and they're competing for $125,000 in cash prizes. And it's very exciting. You know, one thing I was thinking about, I want to commend the students that are here for their interest in entrepreneurship and innovation. You know, as a world, we face so much uncertainty, a lot of debt. We've got really high inflation. The best way to combat this debt and inflation is through innovation and entrepreneurship. So thank you all for what you're doing. Really appreciate it. You know, Northwest Arkansas has entrepreneurship in our DNA. You know, Bentonville is the home of the headquarters of Walmart, which is the Fortune 1 company, founded by Sam Walton from very humble beginnings, starting in 1962. And we also, of course, have J.B. Hunt, Tyson, but there's a lot of early stage companies now. And I hope, and several of the founders are here tonight, and I hope the student teams, even from other schools, will have a chance to meet some of them. It's my pleasure to introduce the two keynote speakers tonight, really impressive people. If you are in entrepreneurship or investing or in the Heartland, you've probably heard of Anna Mason. She is here tonight as one of the keynotes, and she will be interviewed by Carter Malloy. Now, Anna is co-founder of a movement called Rise of the Rest with the founder of AOL, Steve Case. And Rise of the Rest, the mission is to provide visibility and momentum to entrepreneurs in what is sometimes called flyover country. But I don't think that's the right term for it. Some people fly over, but smart people land. So I call it land country. But more recently, starting actually in November, Anna has taken on a new role as managing partner of Ingeborg Investments, which is, she's doing it with Olivia Walton, and it's a company that invests in women and women-related assets. Really exciting. I just got to talk to her about it a little bit beforehand. And she's going to be interviewed tonight by Carter Malloy, our very own, from the University of Arkansas. And he started a company called AcreTrader, which is a farmland investment platform. It's amazing. If you haven't read about it, just Google it, read an article about it. I've been following it since the early days, and we're really proud of Carter and what he's done. So Carter and Anna, why don't you come up? And Carter and Anna, I want to thank you for your generous gift of your time and presence with us today. We really appreciate it.
So I'm really excited to be here with my friend, Anna, my former investor, so quasi-boss at one point in time. So we met three and a half years ago, and as Anna was evaluating our business as a potential investment. And I think we missed each other maybe for a moment on a round, but ultimately Anna's fund.
I tried to get in and I couldn't get into the round.
Timing doesn't always work out, but it did in the end. And Anna became an investor in our business, and I think more importantly, a trusted advisor and a friend. And for any of you in the room that have raised money or plan on raising money, it's really, really important to choose your friends wisely. In the case of Anna, we were just very, very fortunate that we immediately built this rapport, and it's like, wow, this is a person that I believe I can really trust. But you never know until things get bad. And I promise, no matter what you're starting or what you're doing, if you're early in your career wanting to start up a business, there will be some really bad moments. And I can remember when the first one of those passed and the second one of those passed, and both times there was not a moment's hesitation from Anna of she had our back, and no matter what, we were good to go. So I'm honored to get to interview you here with everyone tonight. So maybe to start, Anna, imagining you're one of the folks in the room who has a great idea. Maybe you've even won a competition. Maybe you didn't win the competition, but you're convinced your idea is really good. What next?
Thanks, Carter. And I'll also just say, as I kick off answering this question, that usually the investors are asking the entrepreneurs all the questions, so I'm sure Carter's got a few zingers.
I'm really enjoying
this.
this.
It's like a great turning of the tables. I think the very first thing you want to do is talk to people. My sense is that oftentimes the instinct, when you have what you believe is a really great idea, is that you kind of want to hoard it. You're like, oh my goodness, I have figured out this brilliant idea that perhaps no one else in the entire world has thought of, and so I'm just going to go under the hood and I'm going to hoard this idea and figure it out. And I actually think one of perhaps the most important thing is to just push through that tendency if that's what exists. So what I actually think you need to do is talk to as many people as you can. I would say first, you really want to talk to people that you think may be your customers, and that's probably my biggest insight and reflection is it's great to have a great idea. Lots of people have great, brilliant ideas. One of the things you're really going to want to figure out if you're sitting in this room, if you're one of the fearless entrepreneurs who's decided to try to figure out how to turn that idea into a business, that I think is the critical inflection point when you decide if you're going to hold hands with the partners and co-founders, other investors that hopefully you're also talking to, sort of jump off this cliff of entrepreneurship together. So I think my very first recommendation is talk to people and talk to potential customers and figure out if your idea can actually be a credible business.
As an admission of guilt, when AcreTrader was an infant of an idea in a slide deck, I think the first 5 or 6 people I showed it to, I made them sign an NDA. Because I thought, well, this idea is so brilliant, that's all that matters. And my friend Jeff Amarai, I don't know if he's here, but he used some choice words and some cuss words I'm going to try to avoid on stage tonight to tell me how poor of an idea that was to get somebody to sign an NDA, because guess what, your idea is actually not that great. And no matter how great your idea is, execution is actually all that matters. So, all right, let's invert that then, all right? So I have this good idea. I've gotten a ton of advice from potential customers, from friends and family, and they've said, hey, this seems like a pretty good idea as well. What are the reasons I should not pursue this?
If you want to maintain your sanity, first and foremost. No, I'm kidding. I'm kidding. Everyone should pursue their ideas. I got some really great advice once in a very different context, which was that it's always easy if you start with the end in mind. And I think that very much so applies to the world of entrepreneurship and to innovation. And that, to me, the inverse of that is perhaps the answer to your question of why not to start. I think really understanding what your end ambition is, what your end goal is. If you're in it to make a quick buck and be on the cover of TechCrunch and and have your moment in the startup son as a unicorn, I think that's absolutely not the reason to build the business. First, it's not a quick buck, and it's a tremendous amount of hard work. And so I think really just evaluating as honestly as you can why you're doing what you're doing. I have so much awe and admiration and respect for entrepreneurs who I often say are just realistic optimists who envision a world where there must be a better way for whatever it is in the industry and the product, the service that they're trying to bring into the world. And so if that is your end goal, then I think you absolutely start with that end in mind. If it's something else, then maybe go back to the day job and back to the drawing board and figure out what's next.
What percentage of companies do fail? So I've got this idea, I've got through your gates, all right, I'm gonna go start the company. What are my odds of actually succeeding?
In the venture world specifically, I think not all businesses are startups per se by venture terms. It's essentially 90% of businesses don't make it. I think it's something like 70% don't make it within the first year.
All right, that's daunting.
Do you have a more inspirational question?
So, all right, but I'm stubborn. I'm gonna do it anyway. I got a 10% chance, but you know what? I'm the smartest person in the room. So, or I'm driven, or whatever the thing is that pushes people to make that decision, to be just a little bit crazy and a little bit stupid and chase their idea. At what moment do you know you're wrong? Right? When do I recognize, hey, all right, in fact, there's a real chance I'm part of that 90%. This is not going to work. And either I should stop or I should pivot, and I should do so soon. What are the signals that one should look out for there?
Well, first, I think in some respects it depends on where you are in your journey. The further along you go, the more capital you raise, the more people you hire, the more stakeholders and champions that start to surround your business. I think the higher the stakes, certainly in your own mind, and I think that can just create a lot of tension. So I think stopping and pivoting are really different. When I think about businesses that I think successfully pivot, it's often when, I think you want to get pulled into a pivot. You don't want to push or force yourself into a business pivot. I think oftentimes that may just be kind of desperation, trying to figure it out when perhaps actually the best decision is to stop. But I think there are tons of great businesses, more than I can think of, more than I know about, that have very, very successfully pivoted. And oftentimes this goes back to maybe my very first foundational point, which is talking to your customers, understanding whether or not this idea really is a business with merit. And so oftentimes I think the consumer, not necessarily the consumer, your customer can really pull you in a new direction. I think that can be a really exciting pivot.
You've seen an unbelievable number of early stage companies. Of those that you invested in and that became successes, how many or what percentage of them did in fact pivot or change their path materially?
Oh, I don't know.
Give us a guess.
Fewer than 10%. Not that many.
Did fewer than 10 pivoted?
Fewer than 10 pivoted and succeeded. I think it depends on the type of business that it is. Ask me another question.
So, all right, sounds like a pivot is a mistake by those odds.
I'm pivoting.
Aside from pivots, what are some of the other mistakes that you see as highly common among early stage founders?
Cash management is one, and that's very much so a hot topic in the venture industry right now. I would say it's been an evolving hot topic, actually, for the last couple of years, maybe ever since WeWork's initial failed IPO in some respects. Cash management is incredibly important. I think I have seen it to be a challenge, in particular for many early stage founders, for a number of reasons. One, it's like oftentimes the least exciting, most unsexy part of the business is the fundamental business of running your business. You kind of want to be out there selling your product, selling your service, building your product, and sometimes you think, booked revenue is actually cash in the bank, and that's not necessarily true. So really getting a handle on that very early on, or figuring out how you can bring in the right support to manage that is incredibly important. Something else that I've seen that I think really throws companies off early, in some respects better early than late, is co-founder dynamics. I think startups are very much so business marriages, and you have an incredible co-founder. I love spending time with both of you guys. It's a testament to, I think, what's possible. But sometimes, for lack of a better term, I see a lot of founders that have shotgun founder weddings, and there's a lot of asymmetry in the level of responsibility and work that you actually end up seeing coming to the fore, and that can cause a lot of tension. And I think that breaks up founders, it turns off investors, and that's a big one. And I think the last, and again, I guess this is not a theme, but I do keep going back to this, is you see startups that don't talk to their customers enough. And you're kind of in your own echo chamber, and you don't have your ear to the proverbial ground on what's working, what's not, what are the micro changes that you can continue to make over time that ultimately add up and transition your company into that big success down the line.
This brings up an idea.
How'd I do on the pivot?
What's that?
How'd I do on the pivot?
It was beautiful. So this brings up an idea that my friend Matt Tarver here told me early on in our business, sincerely, it was important, is stop focusing on scalability, do things that don't scale. And I wonder what lessons you've seen in that, and how important that is for individual founders. Let me rephrase this as a question. In the early stages of my business, I'm one of the folks here, I'm about to start a business. How much should I be focusing on the scalability of this idea versus this type of product discovery, customer discovery journey?
Well, Matt's a really smart guy. I learn from him all the time too, and I think he's 100% right in this case.
In this case.
In this case. So, in the early days, every organization is the sum of its people. Every product or service or business at scale is the product of many small successes and micro successes along the way. So I think focusing on, I wouldn't necessarily only say focus on the things that don't scale. That's a mantra you hear a lot, kind of you can hear a lot in the venture community. I think it's really just focusing on those foundational business blocks that taken together over time with a lot of hard work ultimately can make your business succeed at scale.
Great. So speaking of sometimes being right, I love being right. I don't know about you guys, but it feels really good when you win an argument. That's not a great mindset. I'm going to make sure I disclaim that. Importantly, in our business, I think some of the most really foundational moments are ones where I'm able to recognize, wait, I was really wrong about that. And I still don't do that remotely enough, right? I'm human, I'm emotional, I have an ego, I want to be right. How often and/or how important do you believe it is that, I think you used this word earlier, realistic optimism, right? How often should we be challenging our own assumptions and saying out loud, and not just to ourselves, but the people around us, I was wrong?
Yeah, I mean, I don't know if you need to stand in front of the mirror in the bathroom, all
or
day
a room full
long,
of people.
say, I was wrong. I'll maybe flip the question a little bit. I think, and I think you're a great example of this, it's really important, not just in venture, but probably in life, to just try to put yourself in a room where you are far from the smartest person in the room, and where I think this dynamic becomes really important. When I think about that question, do you want to say it to yourself and beat yourself into submission? Are you saying it to your co-founders, your executive team, your broader team, your investors, the public? I think that it's a really nuanced answer depending on who the audience is. I don't think you want to necessarily stand up in front of your fledgling team and say, I was wrong. You'll probably have people running for the doors in some capacity. but knowing when, you made this point earlier that it's not just about the idea, but I think really the transition from idea to business has so much to do with the strategy that you deploy. And so figuring out how that comes to life, you're definitely never going to get it 100% right. And knowing when to take the advice and when to stick to your guns to say, no, all because everyone's done it this way. Well, actually, this is my innovation for how we're going to do it the other way. That is such a hard unlock, and it's such a nuanced question. So I do think you need to be honest and transparent. There's nothing wrong with saying you got it wrong. I just think you need to be thoughtful about the environments that you say it in and how you actually get to that point, like who you're surrounding yourself in the room with.
So venture investors tend to, or very often focus on a couple of foundational pillars of what they would define as a business that's scalable. And that is usually the market. Is this a huge TAM or whatever? Everybody's annoyed by TAM slides, but is this a very large market that you're participating in? The product, does the product fit within that market? So you have product market fit. And then the people behind that. As an early stage founder, I've just discovered my product and hey, I've talked to my customers and followed your advice and done some discovery and recognized that there's a real opportunity here. The emphasis in those early years, or early weeks and months for that matter, should it be more focused on the product or the people?
It's like the proverbial chicken and egg question. I'm team people. I think I'm always team people. It was a lesson I learned very early in my career, in a very different industry. We both were forged in the fires of Wall Street in another lifetime. That was a foundational experience for me for a lot of reasons. I think one of the most important was I actually saw the crumbling of a 100-year plus Wall Street institution. And in that transition, that taught me very quickly that every organization, whether it's a 5-person startup or a 50,000-person multinational corporation, is truly the sum of its people. And I think great people build great products.
All right, great. So I'm starting my business. I agree with your statement. I've begun to surround myself with other good people. How soon should I be focusing my time on developing those folks and management versus building my product?
I think management is a tactic, and when you're an early stage founder, I think your first principle should actually be leadership over management for a whole host of reasons. One, you are fundamentally trying to create something out of nothing, and so that's going to require a number of people who join you to suspend disbelief and kind of hold hands and jump with you and know that that's possible. And so I think first really aligning on those North Star principles of the company are actually, I think, the critical first principle when I think about team formation and team growth. By extension, I think once you have your mission, once you know what the vision of the world looks like, if you have succeeded in this mission and building this business, then you get to strategy, then you get to action plan, then you get into those tactics of management. And a lot of it, I think, will flow more naturally. There are tons of things to be done, but I'd actually start leadership over management.
It's a fantastic answer. All right, so
my other answers,
they're okay. That one was great. So, all right, so I've got a product, I got a team, I've got a big market. I'm convinced, these folks with me are convinced. How do I start? Like, now I want to come talk to you and have you give me money, right? How does that work? How do I prepare for raising capital?
Well, two different questions. One, on the how you start, and again, this is just a testament and truly a recognition to all of the entrepreneur teams in the room. Putting yourself out there in situations like this, getting up on stages, finding those communities, those tribes where you can continue to create some third-party associations and recognition with your business is actually, I think, an incredible is a critical building block that sometimes very helpfully precedes the actual formal fundraise. In terms of getting ready for a fundraise, I think from what I've seen from a lot of the founders I've met with over the years, it can feel like a very daunting part of the business. And so the advice I often offer is to reframe your perspective and just think about it as another sales motion. Because that, at the end of the day, that is what you are doing. Instead of going out there and selling your product, you're selling equity in your business. So it truly is not it's a very similar motion. And so from first principles, then I think you think, well, what am I, if I'm going out there and I'm selling my product, I've got this great product that I've built, I'm gonna go convince investors about that too. What are the materials that you prepared to go sell your customers? You wanna take pages out of those playbooks and repurpose them for the investor community. And there are two-dimensional aspects of preparation and three-dimensional aspects of preparation. I think the very first thing you need to do before you walk into a room with any investor is really be able to fundamentally answer three questions. Why me? Why now? Who cares? From an investor standpoint, that's fundamentally the first thing I'm screening for in an initial conversation. And I really think it sets founders and early stage startup teams up for success when they can answer that question for themselves.
So dig into that further, right? So that's the first things you're looking for. What else would you or someone like you in your business, what types of characteristics are they looking from that founder? What are they wanting to see in those pitch materials early on? Like what gets folks excited? And then I'll invert the question in a moment.
Sure. I'll answer that in a couple ways. First is maybe I'll flip the question a little bit towards some advice if you're out there thinking about preparing a pitch deck. One of the things I often encourage entrepreneurs to, in particular female entrepreneurs, diverse entrepreneurs, is to not bury the lead. And by that I mean you, the founder, and your team. Oftentimes I see, this is like a small gripe, but since I'm up here, I'll go for it. Oftentimes I see founder slides at the very end of a deck. And I think in general, you walk into a pitch meeting, and for better or worse, as the founder, you're playing defense out of the gate. And so figuring out the strategies and tactics that you can use to go on offense, I think are incredibly important, incredibly productive. Happy to talk about that more later. In terms of what else I look for, and this evolves over the course of not just one, but many conversations. One, I'm trying to get a handle on whether or not the founder of the team has some sort of asymmetric information advantage and insight. Like truly, what is this unique insight that you are bringing into this market? And so that can mean a whole host of things. It can mean the lived experience. It can mean the professional experience, some unlock. So really understanding that is a critical piece of it for me. You talked a little bit about TAM, so I won't go down that, won't go down that page in the slide deck. But once you get past that first meeting, some of the things I also start to screen for when you're thinking about, is this a nice business, a good business, does this have venture scale potential, is also understanding that, you're really looking at the founder's capabilities to scale a business, to lead people. And so sometimes in follow-up, discussions and conversations, you may ask as an investor to bring on other members of the team and hear more from them. And sometimes I find that it's less about what the team says, and it's more about how the founder or CEO manages the discussion and guides the discussion. I've been in these meetings where we can have an hour blocked out, 4 team members get on, and actually the CEO talks the entire time and doesn't give their team any airtime at all. And I find that, for example, to be very telling about both a leadership and a management style.
Telling that it's not good, right?
It's not good. You're not going to get third call.
So that's one thing it sounds like folks should watch out for or not do. But let's presume that it's a good person, they are a good manager, a good leader, rather, early on. They've got a great product and a great market. What are the things that folks should absolutely not do? Like, well-intentioned people make mistakes all the time when presenting to you or visiting with you in these early conversations. So what are the things I should be watching out for as this aspiring entrepreneur trying to raise capital?
Sure. So I think we've evolved into this hybrid pitching era that was ushered in some respects accelerated by the pandemic, where there's a ton of pitching that happens over Zoom, which I think ultimately has actually been net incredibly positive for the unlock of capital and kind of the cross-capitalization across a lot of geographies, which I think is incredibly important. You would be shocked, I hope, at how many pitch meetings I had taken from 2020 through maybe mid-2022, where, like, in the founder background, there's like a crumpled bed sheet. Like, literally, I'm like, make your effing bed. And you're raising like $4 million, $10 million, $1, make your bed. And I think maybe taking the joke out of it, though it's not a joke, like make your bed. I think the way you present is, to me, a window into how you operate, into how you manage, and so I think just some of that signaling goes a long way in both directions.
That's fantastic. So you take Wesley Clark is one of our folks here, and that's a quote of his: is you want to start every day with a little success of making your bed. All right, so you don't like people that are messy. We get it. What else? What are other like faux pas that I'm not thinking about? Right, I'm like really excited about my idea and my team and my product and my market. What else am I really not thinking about where I'm going to get stumped in my first couple of years?
Sure. Okay, let's go some specifics. So everyone focuses a lot on the pitch deck. That is a like 2-dimensional 10-slide window into what is hopefully a very 3-dimensional, multifaceted, likely complicated product and business that you're building. So you need to be prepared, just tactically, you need to be prepared with more than just the pitch deck. So oftentimes I think what I've seen with very successful raises at the early stages is you map things out in advance. And I say this with the recognition and the empathy that this is an incredibly difficult fundraising environment for everyone. But what can help set you up for success is being prepared with more than just the first pitch deck, with more than just the first meeting. And that goes, some of the ways that you can get there. First, you want to, quote unquote, know your customer. If your investors are your customers, you want to try to do the diligence in advance, figure out who that list of targets are, identify who might be your first, on your first list of calls, your secondary and tertiary targets, kind of have it all lined up, so you want to try to block it out and actually block and tackle through your fundraise with like military-ish precision, so that you're targeting lead investors first, then you're going to syndicate checks afterwards. You have a very organized data room prepared. Maybe you have, you want to have a great demo of your product, and you want to have it ready to go and tested before you get onto the call. So I'm not sure if this is the kind of thing you were talking about, but I think there are certain specific tactical steps you can take to actually set up a holistic fundraising strategy that can really set you up for success or increase your chances of success.
So is part of that strategy, and not that all VCs have groupthink, but how do I create excitement around that fundraise, right? All right, so strategically I know if I get a term sheet, I'm more likely to get a second term sheet, right? If I create excitement around this round, or if you go build demand in advance of a quick sprint, what types of strategies have you seen in terms of approach to market be successful? And then again, inversely, what are some things you've seen where people have really fallen over?
I've seen the fundraise be really successful, and so I think what's actually inherent, and I'll say more about what that means, but you can approach this as a transaction or as a relationship. And ultimately, I think what really succeeds is figuring out how you build relationships in the industry. And so your first conversation, you increase your chances for success meaningfully if your first conversation with some of the investors you're targeting isn't when you have your hand out for a check, which just makes it incredibly transactional. So building that relationship, hey, I'm not raising yet, but I'd love to introduce you to my product. I'd love to tell you about some of the progress we're making. A very common tactic that has emerged in the industry over the years is to send out a monthly investor update that actually goes to people who are not investors yet in your business, and you can use that to build some hype, to try to create some FOMO, to share milestones that oftentimes don't necessarily have anything to do with revenue, but demonstrate different ways in which you're de-risking certain aspects of your business. So just taking a more holistic 360 approach to your fundraise, I think is really successful. On the flip side, where I've seen raises go sideways, or when, and again, it's tricky, it's a dance, and it's a tough market. But if you say, oh, I'm raising $3 million, and what's today, April 14th, and I have $1 million committed, and we're closing May 15th. I think the figuring out how to balance like FOMO and undue pressure is a really tricky dance, and that's oftentimes when I've seen things go sideways.
One of the best things I ever heard about this was, if you want advice, ask for money. If you want money, ask for advice.
Yes, true.
All right, so I've got this good guidance. I've got some good ideas on how to approach it. I've read 100 blog posts, and I've got a pretty good sense. We'll talk about maybe safes versus converts and equity in a moment, but I'm going to go to market. I'm ready to go. I met this nice woman, Anna, at Crystal Bridges, and I have a rich uncle. What next? How do I actually find VCs that are interested not only in investing in businesses, but investing in businesses like mine?
So I think, despite what many are probably reading about how difficult the environment is right now, on balance, there are still billions of dollars a year pouring into the venture industry in the United States alone. Even just between the coasts, excluding Silicon Valley, New York City, and Boston, over the last 10 years, 1,500 new venture funds have raised themselves and have come into the market. And I share that as backdrop to answering your question, because I think one of the first things you want to try to do is find your tribe, right? This goes back to my know your customer comment and really thinking about your investors in that context. Not just doing your research on investors, but putting yourself in the literal and figurative room where there are other people who have affinity to what you're building is a really important building block in terms of networking in I think a 360 fashion to ultimately get those introductions. It is hard to cold email investors. Most in the industry won't necessarily respond to that. Everyone talks about like the warm intro. Like, how do you get the warm intro if you don't know the people who know the people? And what I love about the evolution of the startup community is that it really is a community, and I think it's embodied in so many ways just in this room. These aren't just entrepreneurs from Arkansas, though I know there are many in the room, but there are students from Brown, there are students from Hopkins, there are students from Michigan. And so, but there's like a connective tissue that brought you all here for this pitch competition where there are investors in the room, there are other stakeholders. And so figuring out how you, putting yourself out there and putting yourself in those situations is helpful for network building. It's helpful for linearly meeting investors, but it's also helpful to build some of that third-party credibility. I think about it as like the transitive property of credibility. You walk into a room and you don't, you might say where you go to school, you might say what you've done in the past, but now maybe you'll say you won the Heartland Challenge pitch competition, and that's going to mean something. And so I think continuing to do more things like that helps you get in the room.
Fantastic. And then I mentioned a moment ago there's various ways to raise money, right? You can raise debt for your business. You can go to the bank and they'll give you debt if you're real lucky. Outside of that, right, there are convertible notes. There's raising equity, which is probably the most common form of raising capital, especially later stages of a business. There's a new mechanism, a SAFE, a simple agreement for future equity. Can you describe some of these different fundraising styles and what you prefer as an investor, and what the advantages may be to the entrepreneur, what the advantages may be to you.
So I would say time, cost, and actual equity stake are fundamentally the three foundational pieces on the table that cut across those three decisions and three options. Over the last decade, it's been, by and large, a super friendly, like founder-friendly fundraising environment for a whole variety of reasons. And so with that backdrop, and with all the new money, I mentioned the 1,500 new funds that came into the space, there were a lot of crossover investors from other asset classes who got increasingly involved in venture. There's just a lot of competition, right? At the end of the day, it's a supply-demand dynamic where, unlike the stock market, you can't just go. It's a bi-directional access business. Entrepreneurs want to access investors who want to back their businesses, and investors want to access the best entrepreneurs that they think have a chance of generating those returns. And I think a lot of what you see in those three different options in the market, in some respects, were a sign of the times. So from my perspective, from an investor perspective, I think if you can get you ultimately want to get equity in the business as your primary choice. It's more expensive, it takes more time, there are more legal documents, and it just might not always make sense for super early stage business. And at the other end of the spectrum, safes, I think over the last couple years since Y Combinator kind of brought them into the market, have been seen as a more founder-friendly mechanism. And convertible notes sit in the middle. What else can I tell you?
If I show up with a safe, do you care?
I do. I do. I think it depends on the stage of the business. So, for example, if a company has already raised a round of capital, and give you a scenario, your company's raised a round of capital, and now you think you're trending towards what could be a very exciting acquisition, but you need some bridge capital, and I don't necessarily mean that in a bad way, to get your business over the finish line and make it to the promised land of that acquisition. As an investor, I'm constantly thinking about kind of the risk-reward trade-off, and the opportunity cost of where I put my money. So tying up investor capital when I'm ultimately trying to underwrite to those venture scale returns, it's the hockey stick in everybody's pitch deck. Tying money up in something like a safe where your return best case scenario is fundamentally capped isn't all that interesting to me.
Fantastic. All right, so we'll switch gears a little bit. I've got this idea. It's really great.
Is it called AcreTrader?
I don't know if you heard about the benefits of investing in farmland.
Because are you working on a new idea?
So I want to go out and raise capital. And in fact, I'm beginning to see some real traction in my capital raise. It's myself, maybe one co-founder, maybe one other team member. We're really ready to go. Should I be thinking about diversity of my early founding team now? And why? Why does that matter?
Yes. So that was the easy first part of the question. So I'm also approaching this, answering this question maybe as a parent a little bit too, right? Because I think about, everything and everyone's a startup, my kids are startups, and you think about the lessons that I tell them that too. They don't know what I'm talking about, they're like 4. First principles, we talked earlier about leadership versus management, mission and vision versus, strategy and action plan. And the tone you set early is the tone that gets built over the long term. And so, you and I, I know have talked over the years just about diversity of thought and the so many different ways that gets represented. And it's very real that a plurality of perspectives and backgrounds will often drive that diversity of thought. And as even just as a core strategy, you strengthen your business, you strengthen the chances of success by throwing every perspective up against the wall, making sure you're looking at every contour, every nook and cranny to understand how to grow your business, what could go wrong. And so much of that, I think, is driven by who's in the room, who's around the table, and the lived experience, the professional experiences that they bring to the table. The second thing I would say is if you don't build with that intentionality out of the gate, and you wake up 2 years later and you've very successfully raised $50 million, and you have 150 employees, and you're this great success, and you have no diversity, I would argue that it will be incredibly difficult to bring diversity into your team at that point, because you'll have all of these talented people looking around going, well, first, am I the token? And second, you can't be what you can't see. And I think that's incredibly important in the startup world.
Well said. I will say, earlier in my career, before starting this business, I would interview, the company I worked at, interviewed lots and lots of people, and we had the airport test, right? Like as you're interviewing somebody, right, the rule of thumb was, if you were stuck with this person in the airport in 24 hours, would you have a really good time? And it took me a long time, I thought it was a really great idea. It took me a long time to realize that's a really dumb idea, right? Because ultimately what I'm gonna do is surround myself with people that are just like me. And that is a terrible way to build a business. And I also really appreciate the call out of diversity of thought. One of the folks I work with, he is a white dude, but we have very, very different political beliefs. And his are obviously very stupid, mine are great. But we come at problems from very different angles, and I think that idea of a difference in background, difference, like the obvious diversity factors that we all look at are incredibly important in building a business. I think you're very right. After 20 or 30 people, you get this self-fulfilling prophecy of everybody hires their buddies, and then you got that kind of place. It's just not rich with ideas and ways to solve problems. So I appreciate that perspective. All right, so I'm going to invert it a little bit. I've been asking things as a founder, but I think it's always fun to hear a perspective of your business and the way you manage your business. So I think recently we learned like a great illustration of this concept of people are really smart, but crowds are pretty stupid. And we learned this with this little bank called Silicon Valley Bank. How do investors like you avoid groupthink and avoid not becoming trend chasers?
It's a great question for our entire industry. It's tricky. I think, so my like easy answer would be teams, funds, holding themselves to higher standards, doing more of your own work, working from a very like thesis-driven, thesis-oriented standpoint, and I think that then manifests in the types of founders and startups that you end up attracting, and so it can become a self-fulfilling prophecy in both directions, because at the end of the day, like, you make me look good, because like you're the one doing all the hard work and building, so there is that piece of it. The reason why I said it's tricky is that I think there are some systemic issues in the venture industry, because part of the venture model, at least historically, has been grow as fast as you can. Velocity was incredibly important, and because what was valued across the industry by many was velocity and growth, and not necessarily like lowercase s sustainable businesses and business models. Oftentimes, the way that you ate your market was through capital, so you could just outspend everyone, just do it with a better strategy. And so the reason why I say that I think there's a systemic challenge, and I deeply believe everyone needs to do their own work, you need to get away from herd mentality, but when these super large checks can sometimes make or break or bend outcomes, then I think that you get this sort of cyclical effect where then you start watching, like, oh, what are the big mega funds doing? I'm heartened and excited for two reasons that I think we're hopefully moving in an evolved direction as an industry, and we hold ourselves to higher standards with more rigor as investors and as teams. I think one, there is I think there's been a wake-up call across the industry around what type of growth you value, what type of sustainable business you value, and that it isn't necessarily going to be about raising these multi-hundred-million-dollar rounds all the time in terms of what defines success. The second thing I would say, and this is very much so informed by the role I'm very privileged to sit in now, and the space that we focus on investing in now. You know, at Ingeborg, we invest in the full female experience. So that takes us into healthcare, education, the care economy. We think about opportunities with, even though we're business model agnostic, we're very female consumer centric. And I would say that's a space that for a long time has been very, like the data shows you, very, very underinvested. And so seeing more investors, more entrepreneurs move towards these spaces that have been underinvested, I think all of examples like that are great signs of that dynamic shifting a little bit. But I think you're always going to have herd mentality in the industry.
You were describing your children earlier. I too have been rejected by my daughters describing the ideas of first principles and transparency and J-curves. But the herd mentality one is one we recently talked about over dinner. So tell me, you're successful. You've had some amazing investments and a storied career. But tell us the other side of it. Like, tell us some of your biggest failures. What are maybe the worst investment you ever made?
Come on now. It's not going to answer that question.
You want to hear it.
No, it's a super fair and important question. I'm absolutely not going to name a name of specific startups. I'll answer your question a couple different ways. One, I think some of my poorest investment outcomes have come from a fundamental misalignment around what I convinced myself I was investing in and what the founder was building. And one of the kind of maybe mantras I say to myself in investing is don't make sure you don't have a different vision for this business than the founder does, because at the end of the day, it's the founder and that team that's on the front line building. And so that's been an introspection and a learning that I've picked up over the years. Something else that I've learned over time is that, and I realized that I learned this very early on in my career when I was a distressed bond trader, but I had forgotten, because memories can be short, to think through how to apply it in the venture world, is that there is a price at which it makes sense to be a buyer, it makes sense to be a seller. And I think this idea of liquidity in the venture space is something that was always there, and there are shadow funds who buy secondary shares, but I think the perspective is always like go big and ride it all the way till the end. And some of my most deflating investments have been watching the curve run all the way up, unicorn plus status, and then ultimately, a business can fail at any point. It's not just in the early days as an investor. You're looking to evaluate the risk-return trade-off at any point along the continuum, but they truly can fail at any point. And so I think some of the most deflating experiences have been watching startups crush it, having the opportunity as an investor to sell and not taking that opportunity, and then watching it come all the way back down.
All right.
Do you have a happier question, Ted?
All right, we're done.
Want to take some audience questions?
That's exactly where we're headed. Do you guys want to ask Anna questions? Someone does.
Or Carter. Go ahead.
What's your anti-portfolio?
Say it again.
What's your anti-portfolio? How would you miss that?
Oh, sure. There's a great company in Denver called Sondermind that a great investor friend brought me very early on. He was leading the seed round, and at the time I worked at a fund where we were part of a family of a couple different funds. Sondermind was building and innovating, was a marketplace in the mental health space, and one of the other investments at the growth fund that I was at was Talkspace, which at the time was like the darling of mental health. It was the first that had really broken out. And taking the time to understand like different business models and different angles for how you could innovate, how you could create value, and how the evolution of access to mental health would create so many different, powerful, high-value business models. That one's a thorn in my side. So thanks for asking, because I could like name that one.
All right, other questions? So one of the things we interview for at our company is curiosity. Omar.
What are some of the tips that you're recommending to your portfolio companies as you go into these troubling times that's going to them, and what are some guidance?
So I'll answer that question, but I'm going to ask Carter to answer that question first, because he's on the front lines leading a big company in these times.
Yeah, I think we've heard more than a couple of opinions on that recently from our own investors and those that we speak to in the investing community. And look, as a manager of a business, the number one most important job I have is to not run out of cash, no matter what, because there is a binary thing that happens when you run out of cash, and that is you pack your bags and go home. So protecting your cash at all possible costs is important. And I think also the outcome of this, which is probably a positively economically, is an improved focus on unit economics of a business, right? So respect your margins, respect the build, and don't just chase growth for the sake of growth, right? Chase growth because it makes financial sense and there is a financial return for your business. And if you have to grow slower as a result of that, that's okay. And what I believe, thinking as an investor, is that quality will be rewarded just as much as growth will be in the future, right? So in the past, if you were growing 10x year over year, maybe that number in the future is 3x, but you have really great unit economics to prove that, hey, this is in fact a scalable business that will someday really make real money. So I think that seems to be pretty consistent feedback for us. Is make sure you got the right people, the right strategy, the right execution plan, right? Those are always crucial. And then, my God, no matter what you do, don't run out of cash.
It's true. That's what we say. Don't run out of cash. You know, the investors subsidize startups. Maybe that's one way to look at it. And so think like an alternative framework is to think about how you kind of get yourself off those subsidies. Because we're in a market environment right now where they just might not be handed out with as much frequency and excitement as we've seen over the last couple of years. And it's a super tricky spot for founders to be in. I have to imagine there's a tremendous amount of whiplash, you know, thinking about not just figuring out how you operate and play three-dimensional chess through the last couple of years of the pandemic and everything that brought, but then just, coming out and just kind of like hit after hit after hit. I actually think the Silicon Valley Bank episode was really like, traumatic for a lot of founders in the industry, even though the dust settled. I think it's, to your point, it will make stronger businesses, those that emerge from this market cycle. I think will end up being phenomenal, generational, game-changing businesses.
Side note, that guy's got some awesome dogs out there. If y'all saw those, I was distracted. Other questions?
So I would appreciate advice and counsel from both of you while I'm working with young entrepreneurs who do not understand who do not understand what the hiring process should look like. And it's a fraternity brother, a sorority sister, a relative. The shortest line in the supermarket is hiring someone that the entrepreneur knows and unfortunately feels comfortable with without there being any objectivity in terms of background, job matching, et cetera. And I've seen it time and time again. And I would like to get your advice and counsel on how you help first-time entrepreneurs understand that building a team is a very, very significant responsibility.
Carter, I'll modify that question. How has hiring evolved at AcreTrader over the years as you've gone from, two co-founders and a co-closet or whatever, up to the business you are today? Because it goes in stages.
Yeah, it does. I think one is we've gotten a whole lot wrong. The one thing we've gotten really right since day one is hiring. And we placed an incredible emphasis on it. And to be frank, it's the only reason that we're here today, is because we hired well. And so I think it's a really, really appropriate question. I have strong feelings about it, and I can talk for the entire 3 minutes and 48 seconds we have left here, or for another couple of hours. But I will say instead on it, what has remained consistent about our hiring process from day one until today is that the person you see when you interview is usually the best version of that person. And you have to interview them a lot, right? You really want to tease this stuff out. You really want to make sure that there's great fit with your business. And the rule we had from day one is still the same today. Unless every person that meets them is a hell yes, we have to hire this person, just don't hire them. We have missed so many great employees because of that. We've definitely failed in that we've not hired some great employees. But inversely, the brain damage that comes along with hiring the wrong person, if they can be the right person in the wrong seat, right? But the amount of damage you do to your company by making even a single bad hire is just unbelievably measurable, or unbelievably large, sorry. So I feel very, very strongly that you just, unless it absolutely feels perfect, just don't hire them. Unless your co-founder is absolutely perfect person to found the business with, be really careful.
And the only maybe small tactical add-on I would add to that, because it sounds like you're asking from the perspective of working with the entrepreneurs, but maybe not necessarily being on that front line yourself. You can't do it for them. You can't hire for them. I don't think that's a sound or sustainable strategy. And so sometimes you have to show other examples. And I think one of the great things about the evolution and the maturation of the industry is that there's an extraordinary amount of writing and case studies out there. Off the top of my head, I actually think First Round Capital, which is an early stage investor, does a great job of putting out the bat signal into the venture and startup world about how to do some of these very tactical things. So I would say you know what, if you don't believe me, read this article. And you hear both, I think, the winning case studies and the losing ones.
Yeah, that brings up a really important point, which is there's lots of great literature on all these things. If you have a question, check out the internet. It's a really cool place. You don't have to do all this on your own. There's a saying that not all readers lead. Not all great readers lead, but I think I'm saying this right. But all great. I screwed it up. Shit.
So Carter reads so many books. No, this is true.
This is
amazing.
True. Yeah.
What are you reading right now?
I just finished a book called Think Again, and it's a.
I just read that too, Adam Grant.
It's a book about being wrong.
Great.
It's fantastic.
Yeah,
but I'm going to move on.
Okay, we have one last question.
One last question. I've got him right back here.
Hi, my name is Jason Hope. I'm a student at the U of A, and I'm as a young person entering the job market, what advice could y'all give me right now?
Lean in. We often ask people as an interview question, funny enough, are you smart or are you hardworking? And I hope that your answer is the latter. If you want to succeed in starting a business, there is no way around it. You're gonna work incredibly, incredibly hard, or you won't succeed. You have to work hard to get, and then you have to get lucky. But you're not gonna get lucky by just hanging out and having great ideas. Guess what? Everybody does that. So that'd be my simple advice is don't be afraid, like you're gonna fail, and that's okay. Like view those losses as learning experiences, and just be prepared to work really hard.
And I would say,
You probably have better advice than that,
no,
sorry.
that was great, that was great. I think, you know, so much of our conversation has absolutely been angled towards like startup founders. And actually your question is reminding me that foundationally this conversation is really about innovation and like the spirit of entrepreneurship. And you don't need to be a founder to be an entrepreneur. And taking that spirit of possibility and that sense that you can create something out of nothing is something that you can and you should take to any job opportunity, whether you're going to go and be the 5th employee at a startup, you're an entrepreneur too, or you're going to go work for a major corporation where maybe the sentiment is it's harder to change things. Bring that entrepreneurial spirit, and I think you'll get rewarded for it.
That was amazing. We're going to end on that, like mic drop. That was wonderful. Thank you,
Thanks,
Anna. It's been
Carter.
a pleasure.
Thanks, everyone.